You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
Some economists are predicting a market crash by next year. Some are saying that's complete hogwash and the economy is healthy and in full recovery. I've had so many varying perspectives here on The Real Wealth Show, it can be pretty confusing. So who's right? Who can truly predict the future? Well, Harry Dent seems to sure think he can, and he's here to tell us why. I'm Kathy Fettke, and welcome to The Real Wealth Show. My guest today, Harry Dent, is a Harvard MBA grad and a well-known forecaster. You've probably seen him or heard him on Good Morning America, Fox Business News, PBS, CNBC and CNN, Entrepreneur Magazine, Fortune, Success, U.S. News and World Report, Business Week, The Wall Street Journal. He's all over the place. And lately, he's been the voice of doom and gloom. But unlike other doom and gloomers, he's had more of a history of being positive. He predicted booms with his book, The Great Boom Ahead, back in 1992. That was in the midst of a recession, so most people thought he was crazy, far too optimistic, and way off the mark. But he was dead on. He authored 2 consecutive bestsellers, The Roaring 2000s, and then The Next Great Bubble Boom. Mr. Dent bases much of his analysis and predictions on demographic changes. He summarizes fascinating data on this topic in his more recent book, The Demographic Cliff, which I highly recommend and use a lot of that research for our forecasting at Real Wealth Network. Now he's got a new book out, and trust me, I'll be reading this one several times as well. It's called The Sale of a Lifetime, and I can't wait to hear all about it right now. So, Harry Dent, welcome back to The Real Wealth Show. It's great to have you here.
Yeah, nice to be back, Kathy.
You know, I'm a big fan, and I'm excited about your new book, The Sale of a Lifetime. I love sales in clothing, shoes, food, and definitely real estate and stocks. So hopefully we're talking about real estate and stocks here.
Oh, yeah.
Yeah, I mean, I know in the last time you were on the show, you were predicting a pretty severe crash either this summer or after the election. Has your forecast changed there?
I mean, we're just having to watch this this unprecedented thing where governments are just literally trying to stop, the economy from deleveraging the biggest debt bubble in history. They think they can do that. You can't stop something like that forever. The Japanese have been trying to fight it for 26, 27 years now and are still got a coma economy. And, it doesn't allow the natural free market systems to do their work. I mean, after a bubble like this in debt and financial asset bubbles and real estate, by the way, I just read an article today in China. The new thing is 6 square meter. That's 66 square foot condos in Shenzhen, their main industrial city, the most expensive city now in China, are selling for $132,000 US. 66 square feet. That's what a single person working in Shenzhen now has to live in on their $15,000 to $20,000 salary, which is way above average in China. So,
wow.
These bubbles need to be purged. Stocks are so expensive today, just like they were in 2000 and 2007 and 29 and many others. If you buy stocks today as a young person investing for the future, your expected return is minus 2% for the next decade, even without my forecast of a down economy, just from overvaluation. It's the same with real estate. Real estate is so expensive in more and more cities, especially cities where foreigners are buying, like London or New York or San Francisco or Vancouver or, Sydney, Australia or Singapore, et cetera, that the people living there can't afford to live there anymore. And they're having to move out. And Vancouver slapped a tax, big tax on foreign buyers, and Singapore did it before them. And so, these things are not sustainable. They're not good for the economy. Real estate, being at extreme levels, is only good for people who've already owned it in the past and own it now. It's not good for the young families that are going to drive our economy in the future and need affordable housing again. So I see this as a good thing. We need a reset. It's natural to have a bubble at the end of a long-term boom. We've been booming like crazy ever since 1932 in stocks and 1933 in real estate. And we're saying we're going to get a similar buying opportunity as back then. If you'd have bought any stock that didn't go bankrupt or company, if you'd have bought any real estate still standing in that 32, 33 timeframe, you'd have made money for decades and decades, especially into the next boom into the late 1960s, early 70s. So we're seeing that sort of opportunity here and warning people that, look, things are just way, and I mean way overvalued. And the demographic trends are not good for stocks because baby boomers are going to spend less for many years before the next generation comes along, and they don't have the same wages and employment and benefits. And real estate, we have a whole new thing in the last few years on real estate. Instead of just looking at when people spend the most on real estate, which is about age 41 to 42 in the United States, we have to look at real estate, which is such a long-term asset that lasts forever, as, wait a minute, we have to look at the people who are buying, peak at age 41 to 42. We have to look at the people who are dying at age 79 to 80 in present-day terms, because dyers are sellers in real estate. And
Yes.
real estate lasts so long that matters. And in the United States, when I look at the net demand from baby boomers dying versus millennials buying, it trends down until 2039. So if you don't buy real estate when it's fairly valued, you're not going to lose money from buying at high valuation. You're going to be in a market that's going to be struggling for a long time. You're going to have to buy real estate smart to get a bargain and be able to afford a place you can afford, and that will not go down even in a decent economy, because that's just, real estate is affected by demographics more than any other sector. Everything's affected. Potato chips, weight, hospitals. I mean, there's nothing I find that I can't tell people that there's an up and down trend of when people buy certain things, or when they gain weight or lose weight, or when they eat more calories or less, and, all this sort of stuff. So
Yeah.
demographics is important.
Well, it was so interesting, of course, watching the presidential debate that I had to keep checking in to make sure it wasn't Saturday Night Live. It was actually the real thing, our two choices for president of the United States. But, of course, the first topic they mentioned was jobs and bringing them back. And I was just laughing, thinking, those jobs aren't coming back.
Not coming back.
There's more leaving. And if they're not leaving, they're going to be here, but they're going to be robots and automation. I mean, our politicians are living in the past. That doesn't even so much apply to what you were just saying, but I have so many economists on the show. I just had Alan Weiss this week. He is the founder and CEO of Weiss Analytics, and he was the creator with Robert Shiller of the Case-Shiller-Weiss Index. So you would think he might know a thing or two about, bubbles and markets and so forth. And he said, it was just completely opposite of what you say. He said that the safest place to be in today in real estate is high-end real estate. I was like, what? Yeah.
I mean, I've got a graph in this book that I've been using for years. And I said to people, what was the leading city without any doubt back in the roaring 20s bubble and boom? And it was New York City. We were the up and coming. We were like Shanghai today, or and New York's still a leading city. New York crashed 61% in the 1930s crash, when the average house went down 26, so 2.5 times more. And the average house came back to where it was by 1940, and New York was still on its bottom. Then didn't get back to those levels till the mid-1950s. It took slightly longer for New York real estate to come back than the Dow Jones, which crashed 89% in the 1932. History shows the greater the bubble, the greater the burst. It's true of real estate, stocks. It's the stocks that go up the most and get valued the most because they're special, precisely because they're special. In fact, General Motors became the greatest company in the world after the Great Depression, all the way into the 1960s. For decades, they made a profit every year of the Great Depression, and their stock went down 93%, more than the Dow, more than the average, because they got so valued in the boom, in the bubble. So, I mean, I would rather own farmland in Iowa any day of the week than a condo in Manhattan or London or Vancouver or Sydney, Australia. I mean, those are the areas that are going to get cremated without a question. History crystal clear on this.
And San Francisco, I imagine.
Oh, absolutely. San Francisco, outside of Manhattan itself, that concentrated part of New York, San Francisco is probably the most highly valued city in the United States. Vancouver's worse than San Francisco, if you can imagine.
Yeah, no, Vancouver's a mess. And that's mostly from foreign, mainly Chinese money, right?
Yeah.
Just pouring in.
Tired.
All right. One of the things I did actually agree with Alan Weiss, that he felt Reno was a solid place to invest because of all the growth and the job growth there that are jobs of the future, not the past. What are your thoughts on that?
Yeah, well, first of all, Nevada and Arizona were two of the bigger bubbles. I mean, the whole subprime crisis was California, Arizona, Nevada, and Florida. But you know what? Those two states didn't bubble so much at the time. Miami's higher than ever in the best places, and parts of Florida more bubbly than ever, California more bubbly than ever. But Arizona and Nevada are much more affordable and did not bubble up so much this time. So yes, if I was going to buy real estate, Reno would look a lot better than most of the big coastal cities that are bubbled up so much. And, Las Vegas is kind of a big retirement city. And that's going to benefit from the aging of baby boomers, as will Arizona, whereas California will not, and some other states will not. New York will not benefit from the aging baby boomers. Aging baby boomers are going to move out of expensive northeastern and midwestern states down into the southern states like Florida, like Arizona and Nevada and places like that. So, yeah, Reno is someplace I would be willing to look at, even knowing the downside. I'd just be more cautious than him because I know, when things go down, when the stock market goes down, everything goes down. It's just some stocks more than others. It's the same with real estate. Some go down a little, some go down a lot. I would see much less downside in Reno, and that's a good place to pick up real estate when we do see a downturn, because it's not going to have that same dyers versus buyers dilemma, because it's going to attract retirees. That's a very affordable place. Reno and Las Vegas are very affordable places for baby boom retirees.
Yeah, and lots of job growth in Reno. So we know there's a bubble, and we know that the government's trying to prevent it from the air coming out of it. But when will they just not be able to control it any longer?
Well, there's two things to that. One is we've got this graph we call, the 0 point. And we've been using this graph a long time. Mark Faber also uses it. If you look at how much dollars of GDP is created for a dollar of new debt or added debt, that's been declining since the mid to late 60s and is now getting very close to zero. There comes a point where you just can't encourage more debt or speculation or print more money and create growth because people can't use it. I mean, the whole point of making money easier and cheaper is for people to borrow money from banks and invest in their homes, invest in their business and stuff. But businesses already overinvested in the bubble boom. Consumers bought much bigger houses than they would normally in the bubble boom with low down payments and low interest rates and teaser loans and all this sort of stuff. And so now baby boomers are sitting in darn near empty homes because their kids have left, and some of them are still underwater and can't even refinance it, nevertheless sell it. So there's a point where it just doesn't work. That's number one. Number two, bubbles defeat themselves. Governments, since they can't get people to borrow money and can't get businesses to invest in the future, then they're using the wealth effect. They keep the markets up. People feel wealthier, especially the top 0.1%, 1%, 10%, even 20%, who own almost all the financial assets. They feel richer and they spend a little more. But bubbles defeat themselves. So they keep driving up stocks and real estate, which is happening. These bubbles will burst at some point. All it will take is something to go wrong. And then when a bubble bursts, and this is one of the things we show in the book very clearly, back in 1929, stock bubble burst, and the Nikkei bubble burst in 1990, and the tech bubble burst in 2000 forward, and the recent China bubble burst. Half of that bubble burst stocks will come in the first 2.5 to 3 months. That's where governments lose control. Something goes wrong. I'll tell you what can go wrong. Crackers start defaulting when oil hits my $20 forecast in the next year or so. More so, sooner. Deutsche Bank is bankrupt. One problem after the next. Now a $14 billion fine from the Justice Department, and their market cap on their bank used to be $200 billion. Now it is $16 billion. They're down 92% since 2007. Bad loans all over the place, and Merkel saying, I can't bail them out because I'm pledging not to bail out the Italian banks and other banks in the euro. I can't be a hypocrite. And Italy's got 18% non-performing loans. That is a trigger I think is going to hit by early next year, if not by December. I think the Fed just passed again, wimped out again. Unless the economy goes down significantly, which is not going to be good for stocks or real estate, the Fed is going to have to raise rates in December. And once they start raising rates, markets don't see a quarter point. They see a series of quarter and half points. They're going to see 100 to 150 basis points. And when the Treasury bonds go up that much, so do mortgage rates, and down go stock valuations. They're directly related. So I think this bubble bursts by early next year. And I think that the most likely first trigger, because the frackers are going to default. China's real estate bubble is going to burst bigger than anything in modern history. Mark my words on that. I'm 100% certain on that. Never seen a bubble that big. Never seen something so crazy. But I think the key trigger, kind of like the subprime crisis in the U.S. in early 2008, is going to be Italy is too big to bail out, and they're going to have to start defaulting.
I'm so surprised to hear you say that you think the Fed will raise rates in December, because that will clearly be the trigger. They can't afford to have rates go up. So what makes you think
that's why they didn't raise rates. They know the market is just hanging on. Fundamentals are not behind the market. Their markets are hanging on the Fed's keeping rates at zero forever, and central banks around the world printing money forever. They're hanging on that, and they know as soon as they sense that that trend is reversed, that it's going to keep reversing and the market will throw a tantrum. And that's why they said, yeah, we probably should raise rates, but let's wait. They're going to wait as long as they can. I'm just saying, after waiting this long after the first rate rise, they're going to lose all credibility if they don't raise rates in December, if the economy holds up reasonably. If it doesn't hold up, then stock and real estate are already going to be heading down.
See, it seems like they always come up with some kind of excuse as to why they just can't raise them this time. I mean, look at what happened when they raised them last December, straight into a stock market dip, which then reversed itself, which is still really confounding to me. How is the market still rallying? Is that foreign money, corporations buying back their own stock? Who's buying it?
It's all of that. We're the best house in a bad neighborhood for global stock investors with low rates. Companies are buying back their own stocks. I mean, it's been about 40 to 50% of their gains in this whole bubble is just higher earnings per share because lower shares outstanding. And why? They can buy back stock cheap with low-cost debt. Because the Federal Reserve's push down the cost of corporate loans as well as real estate and mortgage loans and junk bonds and everything else. The frackers would have never gotten off the ground without cheap junk bond financing, much cheaper than normal market rates, and without the Fed goosing the global economy enough to get oil to bounce, because it was $32. And the frackers don't make it at $32. And they've never gotten off the ground, but with all of that, they did. So this sort of stuff causes malinvestment. It causes bubbles. Everybody's out there worrying, all this money printing is going to cause inflation. We said from the beginning, inflation is not the problem. We're in a deflationary era like the 1930s. Deflation always follows bubble booms and debt bubbles. Always, always, always. No exceptions in history for major countries like us. So deflation, all governments are doing with all this money printing and zero interest rates, they're just trying to keep deflation at bay, because once it tips and prices start falling, just like they have already for commodities, but where they start falling for industrial goods and cars and real estate and housing, what's that going to do to bad loans and mortgages and banks and the economy and unemployment stuff? It's going to be a depression. That's what you get. So central banks are desperately trying to prevent debt deleveraging and bubble burst, but the only way they can do it is to keep increasing bubbles, which one day will burst of their own accord. There has not been one exponential bubble, and this is clearly that across the board in history, that did not burst, and when it burst, it didn't burst violently, and it didn't erase the entire bubble largely, if not more. So to erase the entire bubble in real estate that started in early 2000, we got to go down 40, 50, 60% from here. To erase the bubble in stocks that started in late 94, we've got to go down 70, 80%. Once we get there, stocks will be fairly valued again. Real estate will be fairly valued again, pre-bubble levels. And then people can feel good about investing in them long term. Before then, I say stay away. I've been renting my primary home in Florida since I moved from Miami to Tampa with my wife's family and my business. And I said, look, it's overvalued. And now I'm renting in San Juan, Puerto Rico. I still own a home on an island in the Caribbean because that's my safe house. And it's gone from 25 acre to 5 acre zoning, which gives me a huge cushion. There's no way I'll ever lose money on that when I can sell off 4 or 5 acre lots down the road for almost as much as the 25 acre lot was worth. So, I'm like, I don't want to be in real estate when it's overvalued. Once it comes down, I'd be glad if I stay in San Juan to buy a condo here. But right now, there's a bubble in condos only on the beach in San Juan and Puerto Rico. The rest of Puerto Rico is in a mini depression.
Absolutely. I love what you said about land, because we have a similar thing. We have land in Reno, we have land in Costa Rica, which can be parceled off in the case of difficult times and is not leveraged. So,
Right. And both of them track retiring baby boomers. Both of those areas.
Yes, right. So now that we've got our listeners, wanting to slit their throats and just give up, no, just kidding. What can we leave our listeners with that's a positive message, how to prepare for this?
I came up with a different title for a reason. You got to see the opportunity. Fortunes can be made overnight. The thing about bubbles, as much as they exponentially build, they burst even faster. Stock bubbles tend to burst twice as fast as they build, and sometimes faster than that. The China bubble in stocks, the first one was up for 2 years, 600%, and then crashed 70% in 1 year. So if you buy in that crash, that's the sale of a lifetime. Everything's going to be on sale. Like I said, if you'd have bought anything in real estate, commodities, business, even roach droppings, in 1932-33, at the bottom of all those bubbles, then you would have made money, not just for years to follow, but for decades to follow, because you bought at the best price that anybody's seen in U.S. history, even better than after the 74 and the 82 crashes. So that's what we're looking at. This is the winter season. That's when you get bubbles burst. That's when you see the biggest resets in financial assets. And this is when asset allocation, what your stockbroker is going to tell you, isn't going to do you any good. Everything goes down. Even the bond bubble is going to burst at first. That'll be one of the first places to buy. But this is the opportunity. In the next 1, 2, 3, 4, 5 years in different sectors of our economy, you're going to see the lowest prices you're going to see. And the only way to take advantage of it, if you protect your capital and your cash and your assets in the bubble, which means you get out of the bubbles, and then you have the cash and cash flow to buy into them when they crash, when nobody else can, because everybody's going to want to buy a beachfront property in the Hamptons when a $10 million house goes down to $1 million or something crazy like that. Mm-hmm. But nobody will be able to, because no bank will give you a loan, and nobody's going to have the $1 million cash. The person who has $1 million cash will walk in and buy that $10 million home for 10 or 20 cents on the dollar.
Exciting, but also scary leading up to it. So, obviously my listeners have been hearing me say for years, get out of the stock market. There's no collateral. There's no security there. Why gamble your hard-earned retirement that some people have spent 20, 30 years building, in something with no collateral? I don't understand it. I mean, obviously, if it's a good deal, like you said, and the buy is right, that's different. But are there any stocks, Google, Facebook, Amazon, some of these companies that seem to be doing pretty well, will they be okay? Or is it just, like you said, the whole shebang?
No, most of the gains in the last year or two have gone to 5 tech stocks, including companies like Facebook, Netflix, and Amazon and stuff. They bubbled up the most in a bubble. Again, General Motors and the auto companies bubbled up the most in the late 20s. Look, that industry was still early stage and ended up being 10, 20 times bigger in the 50s and 60s boom. But the stocks that led there still did horrible. In fact, did worse than average. So I also went back in the 1930s and said, well, gosh, gambling must have done well, or utilities, or toilet paper and consumer staples and telephones, movies, things that people would still spend on. Well, no, all stocks go down because when you see a crash like this, fear premium goes up. And even a company that does not, like, again, General Motors made a profit every year of the Great Depression, and stock still went down over 90%. What does that tell you? The fear premium sets in, and people sell everything, especially the most highly valued. So I'd rather buy an extremely undervalued stock. I'd rather buy real estate in the middle of this country in some boring place like Omaha that never bubbled in the first place. Or, like you say, in Reno. I have not looked at Reno as much as I have Las Vegas. I'll tell you, this time around, there was not much of a bubble. I'd rather buy in a place that didn't bubble because your downside is less and then your upside when things turn around is better. But I'd even more rather buy when the bubble burst, and maybe a city like that's down 20% when San Francisco's down 70%. And then I buy it 20% off. But at least if I own property like that now, I'd say, well, God, my downside's like 10 or 20%. Dallas and Denver. I think Dallas went down 9% and Denver 14% in the last crash. I don't mind sitting through that with real estate. What I told my wife when we moved to Tampa, I said, I'm calculating to erase the bubble since early 2000. Tampa's going to have to go down 70%. It went down 50% in that crash, and it still got more downside. But 70%, I'm not willing to sit through. I'd rather be in cash and rent and buy when it gets in that arena.
Fascinating. Yeah, and I couldn't agree more with the Middle America cities, Ohio being one of them, Pennsylvania. There's certain pockets where They're just bread and butter America with jobs that don't seem to be too affected by stock market gains or losses. At least that's my hope. All right.
Yeah, and then you look at things, price to income. The majority of housing in the United States has only bubbled a little and some not really at all. And so that's where you want to buy if you're going to buy now. Again, I just think everything's going to be lower because a broad downturn or a bubble burst in the economy will bring everything down at least a little bit and some things down a whole lot. But like we said earlier on in the interview, it is the most bubbly cities that are going to go down the most. I don't have any question about that from studying history.
Now, you mentioned Tampa, and I was just there actually last week. I forgot that you live there. And we were looking at properties about an hour kind of north of it, really like $85,000 properties all fixed up. I mean, do you see an issue there? These properties are renting at $1,100, $1,200 a month.
Well, one of the tests, Kathy, even if you're not renting out the property, if you can rent out a property you're buying now, it's substantial positive cash flow. That's a sign it's not overvalued or not substantial. And since I was in Tampa, I mean, there are always migrations towards Sarasota and St. Pete. That's expensive, bubbly too. The area to go into Tampa is north. That is where it's growing towards, and that's where the more affordable properties are. And you do have to go, like you said, more like 40 to 60 minutes north to get those affordable properties. So that's another thing I say, look, the same with where you live. You're going to be safer living in an exurban, less bubbly area than in a downtown area. You're going to be more safe and less downside potential if you're living in the middle of the country in a medium-sized city and not in New York or Miami or San Francisco or Vancouver, So, it's a spectrum. I think there's downside in almost everything only because this is a once-in-a-lifetime bubble burst like the Great Depression. Again, I looked back and couldn't find anything hardly that went up in the Great Depression in the initial crash. Now, after that, oh my God, the world was your oyster.
Right. Okay, wonderful. All right. Anything else you want to leave us with in preparation for what's coming?
Well, to get the book, I recommend you get it now because the clock's running here. We're featuring it exclusively in the early stages on Amazon. You can go to Amazon or you can go to saleofalifetime.com and we'll hook you directly into there.
Saleofalifetime.com. I like it. That's a little more positive than, what was the last one? The Great Depression ahead?
The demographic list. That was more positive than the Great Depression ahead. Yeah, I'm getting a little tip on that.
All right. Well, Harry Dent, wonderful to have you here on The Real Wealth Show. Thank you so much. Well, that was a lot to think about. And it's not meant to scare you. It's meant to prepare you. We get enough negativity in the world today, but it is important to get different perspectives and to take from it what you need so that you can make great decisions. Now, a lot of people are freaking out and pulling their money out of all investments and sitting in cash. But that's not necessarily the safest place for your money either. The value of the dollar can decline in an instant. And also, if you have all your cash in banks, well, that may not be the safest place for it either. So in my opinion, having my money tied to hard assets is one of the better ways to go, especially if the value is there, if you own something that is worth more than you paid, and if that asset is producing cash flow. Of course, you know where I stand on that. So thank you so much for joining me here on The Real Wealth Show. If you'd like to find out more about demographics, I've written a whole bunch of blogs on the topic. You can find that at realwealthshow.com. And there's a drop-down button that says Learn, and you'll be able to search pretty easily there on our new website. Have a wonderful rest of your day. Enjoy your family. Breathe. And remember that great wealth actually doesn't cost money at all. It comes from having a strong network. I'm Kathy Fettke, and thanks again for joining me here on The Real Wealth Show.